This week on Straight Talk Wealth Radio, Alliance for Lifetime Income says a dramatically different retirement landscape calls for a new approach. Different landscape? New approach? What's wrong with the old one? Well, all I know is that Jason Fickner, who wrote the article, is a pretty smart guy. And he says 50% of households are at risk of not having enough to maintain their standard of living in retirement. 50%. Oh, and another thing, you think that's a challenge? The Peter G. Peterson Foundation says the national debt is $34 trillion and growing. Oh, and Social Security faces serious financial shortfalls. Medicare's hospital insurance trust fund could be exhausted in 12 years. Oh yeah, and President Biden's budget calls for raising $4.3 trillion in revenues. Revenues is another word for taxes. Yeah! I'd like to tell you that we're going to go over it all today on Straight Talk Wealth Radio. But you don't have 5 hours, do you? So I'll tell you what I'm going to do. Today, I'm just going to open up one big whoop-ass can of worms and tell you why they're saying all these nasty things. And then keep watching Straight Talk Wealth Radio. Can you watch radio? And we'll keep unraveling it and show you how we solve it for our clients. I love that music. Hey, it's me, Bruce, from the Straight Talk Wealth Radio studios. No, actually, it's my office. I'm going to do some flipping around, okay? Like sometimes I like going in the studio, having the setting. I might have the screen there, and I've got a lot of things I want to show you. Sometimes I just have a bulletin or something important to talk about from my desk. So that's what we're going to do today. And the main topic I want to do today is get you familiar with some very, very important data sources in planning for the future. Now, let me talk about the data sources, and I want to go back to why this is so important to be aware of these things. The first data source we're going to look at here is the Alliance for Lifetime Income, and that is at protectedincome.org. Great research group that are dedicated to looking at the issues that are facing really boomers and other people as they go into retirement and they need to sustain their income. So you go to their website, they have these really good studies, half of Americans entering peak 65 zone. Now we're going to go into these in future episodes. I'm going to break this down. Both of these sites are a trove of great information about how to anticipate what's coming, how to plan for it in our own retirement. And again, I get a little bit more into our philosophy of why we look at these things so much in our practice here at Straight Talk Wealth. But they've got a good article here. Have Americans entering the peak 65 zone already claim Social Security? People are claiming it earlier. There's a great article on that. We'll do that. New research economic impact study. I think that's the one we're going to look at today. I'm going to break that study down for you. Gene Chatsky has a column with them. Overall, they just have some really great stuff I like. Let's see what's on their menu here. Let's talk about annuities explained, real stories, articles, find a professional, videos. You can wipe that out. You got me right here. You don't need that. Anyway, I cracked myself up. Videos. All right. So this is a great source. We're going to go into some of these studies. The study I want to look at in particular to this week is this one. It's called the Peak Boomers Impact Study. Executive. I just pull out the executive summary. It's not the entire thing. There's some key points. This was released in April of 2024. And it is from, again, the Retirement Income Institute at the Alliance for Lifetime Income. we'll talk about some of this in a minute. We'll go into these issues. I just want to highlight what they are. I'm going to try to keep this to maybe a 20-minute episode today. And the other place that I want to go to, and again, another source I want to bring you that we will delve into in future weeks, is the Peter G. Peterson Foundation. Now, they are, God, there's a lot of depth to that. And I wish I could, we'll go more into it. Like, I'll do one show that'll just be about that. Today, I just want to tap on these two sources, what they're saying, and the issues that they raise for retirement. But the Peter G. Peterson Foundation is all about fiscal, the budget, and about government going broke, and the effects that this will have on the safety net in the United States, because this safety net that we depend on in our retirement, that's a key part of it. I mean, if we just look at their lead articles here, let's see, they've moved them since I kind of filmed the intro, but let's see, they've got CBO, is the CBO. This article is actually June 18th, 2024. Congressional Budget Office updated its budget and economic projections, and it threatens to crowd out, the interest payments are going to crowd out other priorities. National debt is expected to rise. So these are things that are going to affect us, our generation, the boomers and the Gen Xers in retirement. I want to look at that landscape. They have some other, let's say we go back to the homepage here. You find a lot of stuff over in the resource library with them, but I love their charts. Very graphic. They spent a lot of thought. Here, I mean, you could put slideshows and slideshows. Let's look at retirement security and see the kind of charts they have. Essential programs are on an unsustainable path. The growth of entitlement programs. That looks like a single chart. Well, let's see. Let's look at one at a time here. I'll come back to this. We'll look more in future weeks. Trustee reports, the 2021 trustee reports say that Medicare will have a 9% shortfall by 2026, coming pretty soon. Social Security by 2033, they're going to, and this one is repeated all over the place, they're going to need to make a 24% cut in benefits, affecting 70 million beneficiaries for Social Securities. Then you can go into all the sub things. Let's see, what's this chart here? Healthcare, Social Security, and interest spending are driving federal outlays. Major healthcare programs are just costing more and more. The interest on the debt is going to overtake the spending on healthcare programs. Social Security is just kind of creeping along, and it's still like, it's just being crowded out. And that's what this is all about, is how many things are being crowded out. So we will go into lots of future, this might be a regular routine on every episode, is to take a look at the Peter G. Peterson Foundation. But today, let's go back to the Alliance for Lifetime Income and look at, all right, let's take a look at this peak 65 zone. Just to define it, it's a term that keeps coming up. But what we're really going to do is go into the economic impact study in a minute. So when you click on that, where it takes you is Alliance Research. Here you find some key research from the Alliance and CANEX, I forget what that acronym means, and the Protected Retirement Income and Planning Study. This one, I think, is the one we're going to go into today. Anyway, this peak 65, let's talk about what that is. The greatest surge in new retirees in the nation's history is fast approaching. In a mere 2 years, the U.S. will have more 65-year-olds than ever before, with more than 10,000 people turning 65 every day. It's a number that will increase to more than 12,000 a day until the nation reaches its peak 65 moment, which is about right now in 2024. Our nation's retirement system will be tested like never before. To meet this challenge, we've issued a collective call to action based on research to those with important roles to play in providing retirement security for Americans, including employers, public policymakers, and financial professionals. That's me. Let's look at this. Is a great little chart. So this one here, we're about noon today, and it's saying that today already 5,508 people have turned 65 so far today, and by the end of the day we'll be up to 12,000. Did I say 50? What did I say? 5507. Here we're at 5509 already. Let's see, and it's going to click over, and oh, there we're at 5510. Okay. So that's a cool little thing. There's again, articles you go. I just can't recommend this site enough, and we will continue to explore it. But I'm going to go over one key report with you today. I want to talk about this particular report. And actually, let's go back to the Jason Fickner article, just so I'm not leaving you in mystery of who's Jason Fickner, what was all of that about. He basically commentated on the report, and this is under the article on the site that a dramatically different retirement landscape calls for a new approach. And we go through this, and in 2020, the scourge of the novel coronavirus upended countless lives. Oh, this is interesting because it's an older article, and I want to tell you that there's one glitch in this article that changed, but it's almost like even though they thought it was a linchpin, the fact that it changed actually gave us more hope. It improved the situation over what they did. And I'll tell you about that in a minute as we go through this. 2020, the scourge of novel coronavirus upended countless lives and threw markets and economies in turmoil. It's not surprising that in the wake of the pandemic's first wave, many Americans saw their retirement plans derailed too. But the coming storm for that next group of retirees has been brewing for some time. And in a recent economic analysis, economist Jason Fickner makes a case for why we need a new approach to retirement security. All right, let's just go over here real quick. I'll just show you who Jason Fickner is. Bipartisan Policy Center. This tells you who Jason Fickner is. PhD, chief economist at the Bipartisan Policy Center. His research focuses on Social Security, federal tax policy, federal budget policy, retirement security, policy proposals to increase savings and retirement. And mind you, again, we're going to go through these headlines, but when we're done here, before the end of the show, I want to stand back and tell you how this incorporates into how we look at things and why this new approach is something that we're trying to adopt and look at here. And frankly, sometimes people that are in the old approach, you have to shake them loose a little bit and consider all of this data to get them to see that maybe things are going to change. By the way, did I mention that the watchword for Straight Talk Wealth Radio has been since 2009, things are going to change. In fact, before that, because I was doing lectures 2007 and 8, predicting the housing bubble and what you should do about it, how to protect yourself. And we said back then, things are going to change because frankly, they're always going to change. So we're really safe with that. But the point is that we do need a new approach to retirement planning. And the old approach is just having your broker just manage your stock portfolio, and the stock market is your best long-term investment, and the market goes down, but it always comes back up, and all these other things could be changing. It's changing for demographic reasons. It's changing because your life is changing, and it may be changing because the trick of printing money to get us out of every downfall of the economy and the stock market, which is the most important thing, because the economy, that's not nearly as important, like jobs and what's really happening on Main Street, what we really feel like, and inflation, that's not nearly as important as the fact that the stock market's going up for the maybe 5 or 10% of us that just live off of that and are doing well in it. But for the rest of the economy, it doesn't really matter as long as the stock market's going up, right? That's the old approach. And the new approach will eventually catch up with that, and things are going to change. But I digress. So let's go back to Jason Fickner. So he's basically, his research focuses on Social Security, federal tax policy, federal budget policy, retirement security, and policy proposals to increase saving and investment. He's the executive director of the Retirement Income Institute, Alliance for Lifetime Income. So I guess he's the boss over there. Fichner's on the board of directors of, this is a financial regulation government organization or government sponsored. FINRA tells all the financial consultants to stay in line, etc. Significant government experience, etc. So he wrote this article, or this article, excuse me, is about his writing. So, but the coming storm for the next group of retirees has been brewing for some time. In a recent economic analysis, economist Jason Fickner make a case for why we need a new approach to retirement. Firstly, consider the landscape. In just 3 short years, more Americans will reach the traditional age of 65 than ever before. Here's what that looks like. Today alone, 10,000 people, so they pulled this from that other article, are turning 65. That's going to jump to 12,000 people a day by 2024. The watershed moment comes on the heels of an economic downturn and a historic stretch of low interest rates. Now that's changed. So we had this economic downturn that was COVID, and then the Fed killed interest rates. Low interest rates are horrible for savers. We don't want them. They're supposed to stimulate the economy. That's great. And you know what? It's good for that Wall Street stock market, right? And there's no punishment to it. We can print money forever. There's never going to be an adverse result. If the market goes down, we'll drop them lower. If it goes down, we'll go to zero interest rates like they did, or negative interest rates like they did in Japan, right? We could do this forever. Not anymore. The punch bowl has been taken away. And since even this article was written, we've had inflation. And we found out that inflation is a bad tasting medicine. It's the castor oil of what happens when you lower interest rates and you flood markets with money to keep Wall Street happy. And all Wall Street's doing is sitting there, the stock market's going up every time they think we might have had enough of these high interest rates. Let me tell you, these high interest rates for the new type of retirement couldn't be better. And I've talked about this in some past episodes. I'll try to cover that a little bit later. But I mention it here because he's talking about a historic stretch of low interest rates is killing retirees. The good news is if you act now, while we have higher interest rates, you can do incredible things for the security and the future planning of your retirement. But don't miss this moment. These low interest rates, as covered in this article, were incredibly challenging. We're in a better moment right now. And a lot of the rest of the environment is still very challenging, our demographic and where we're going. And ultimately, whether stocks are going to flourish or whether they're going to come down. This housing crash right now, I've got some great guys I want to get into in future episodes that will get underneath the surface on what we're not seeing in the economy and the changes. But this mystery about housing market, I was trying to sell a unit in California here recently, and it's crunching. People aren't paying what they used to pay. This is having an effect. It's slow. No one wants to drop the price on their real estate. They are going to wait until they can't avoid it anymore. And the question is just how long do they wait before real estate markets fall? Real estate markets fall, then all the other repercussions. People start losing jobs. Home Depot doesn't do as much business, etc. And it's a deflationary effect on the economy. And then that deflationary effect can roll out. Deflationary effect, you don't want to hear that in the stock market. That means the market's going to be coming down. Prices on stocks will be coming down when real estate comes down and all these other things. So we are on the cusp of really, in fact, right now we're in stagflation, which means we've got high interest rates, high inflation. The markets haven't quite suffered from it, but when they start to, and they start to go nowhere like the 1970s, as we've covered in past episodes on Straight Talk Wealth, then we'll see more of the rolling out of stagflation. So that's the whole challenge here. But going back to the article, he says the watershed moment comes on the heels of an economic downturn and historic stretch of low interest rates. Fichner points to estimates created by the Center for Retirement Research at Boston College that about 50% of households are at risk of not having enough to maintain their standard of living in retirement. So think about that. Half the people that are getting old and are getting over 65, they're 65 and they don't have enough for retirement. 50% of them. What do you do? Well, so first of all, I can tell you, there's other things that also are at play here. This generation has had more divorce than other generations. The amount of people that come in my office that were set back by an incident like that in life threw their planning off. And so many people, and I don't think it's a bad thing to work past 65. I don't think it's a bad thing to work till you drop if you love your work and there's purpose to it. But I'm telling you, a lot of people we're seeing now are going to be working till they're 75 plus, just as that's just how it's going to go. And so that's the result of this 50% of people at age 65 don't have enough for retirement. So the article goes on, besides personal savings and investments in the markets, Americans have access to only 3 types of protected lifetime income available today. There's only 3 protected income sources that won't run out, hopefully. 1 is pensions, 2 is Social Security, and 3 are annuities. So only 20% of all civilian workers participate in a defined benefit pension. That's this one up here. So only 20% of people, civilian workers, have pensions. Government guys, they got it because they can just put a gun to our head and just tell us to pay for the pensions, and we do. But the private sector, you don't see them too much. With a substantial portion of those workers employed in federal, state, and local governments. Okay, so they're saying civilian workers, so we're talking non-defense industry, but the substantial portion of those are working for the government. We see that in Ventura County in California, where one of our offices has been traditionally. A lot of government workers in Ventura, not so much private industry. And they have pensions. But if you don't work for the government, really, really rare. Undoubtedly, the retirement landscape has changed dramatically. Employer-provided pensions have virtually disappeared, all while Social Security income is accessed too early for people to benefit from the maximum income possible. So if you don't know, your full retirement age is when you get your, quote, full benefit, but it's not really your full benefit because it continues to grow by 8% every year that you don't take it. Now, that's a really complicated, and we'll do another show on just Social Security benefits because that's a really complicated judgment call. Do you just wait till you're 70? Well, sometimes people have life incidents where they just can't wait till they're 70. They might be out of work or they're waiting for something else to ripen. So there's a lot of judgment that goes into whether to take that Social Security early. But the fact is, full retirement age doesn't mean anything other than it's just a marker that if you take it earlier, it's less. If you take it more, you get more. And when you wait, you're waiting 8% per year. So when they say they're taking it too early, they're just saying, why would you want less than the full benefit you could get out of it? Well, life dictates that sometimes. The reality, coupled with the uncertainty of future Social Security benefits and unprecedented numbers of baby boomers retiring earlier than planned, is increasing retirement insecurity for millions of Americans reaching peak 65 in 2024. Here's that. The retirement picture may look bleak, but there is a path forward. All right, we'll talk about that more. They've got some other sources here. Employers can play a critical role. Let's go over to the report that I downloaded here to get a little bit more insight on this. This report is the Peak 65 Economic Impact Study, and I highlighted some key portions of this. From 2024 to 2030, the largest and final cohort of baby boomers, 30.4 million peak boomers in 2022, born from 1959 to 1964. So the baby boom actually goes from 1946 to 1964 in terms of birth. So when the GIs got back from World War II, they survived the Great War. They came home with their girlfriends and they spent a lot of time making babies. God bless them. And we had a lot of kids on the block. When we went to school, it was crowded. And my God, I just remember the block was a constant block party for little kids. That's the baby boom if you didn't see it, if you're born too late. Those babies came from 1946 to 1964, but the peak of it was 1959 to 1964. And those guys, blow this up just a minute, those guys are going to turn age 65 starting in 2022. This study examines how prepared they are to retire and impact the impact of their retirements on the American economy. 2/3 of peak boomers will be financially challenged in retirement. There's also large disparities based on their assets. There's also large disparities in their assets based on gender, race, and ethnicity and education. Don't want to spend the time right now to break this down, but hey, you know what? We will make the link available. If you want to download this report, the link will be available on our site and on YouTube and anywhere else that you might be seeing this. Download the report for yourself and read it. So we're just going to cover the basics here. Peak boomer women will struggle financially in retirement compared to peak boomer man. Boy, do we see that here. I'm telling you, we're going to be focusing in future weeks on just the situation for women in retirement. We just see this coming in our office. I just think women are a little less prepared. They're freaking smart. They're freaking well thought out, and I can't compliment them enough for the educational curve they're willing to go through. A lot of the guys won't. They're too busy, and they don't want to be humbled by an education curve because they know it all. And the women are humble, and they will do an education curve. They will take time to study things. They're more thoughtful about it than the men. I mean, hate to generalize, but there's some truth to that. As retired boomers draw on Social Security and Medicare, their benefits will add $347 billion to retirement spending by 2030. By the way, I do want to mention, and we will bring him back, along this line, one of our best interviews we have ever done has been David M. Walker. David M. Walker was the former Comptroller USA. That means he was the top CPA of the United States government. He ran the Government Accountability Office, the GAO, and he left government because he basically couldn't get anyone in government to listen to him about balancing the budget and not going further in debt, and ultimately what the ramifications of this would be. And he just decided you can't, in government, the people that have to get elected don't want to hear that, and they won't listen to you if you advise them. What they listen to is contributors, donors, and the votes. So they'll do anything to make it. What politician is going to show up to win votes and say, we need to have fewer benefits, we need to pay more taxes, we're lied to you and we're broke and you're in deep hot water like a frog in a pot of boiling water? Gradual. What politician is going to tell you that bad news? None of them. They're not going to get elected on that. So he had to leave government in order to tell the story. We will have him back, and I'll do another complete interview. For actually 5 years, he was the custodian of Social Security and Medicare and managed the accounts. So he told me, Bruce, they call them trust funds, but you can't trust them and they're not funded. We'll have him on a future show regarding this area. Moving on real quick, the value of their financial assets as they turn 65 may not be stable and secure due to the impact of market volatility and their retirement assets. Boy, are we headed for some kind of change. I don't know if we get through this current situation of higher interest rates trying to slow inflation and no effect on the markets. It will be a miracle, and I will set up, like Buddha of Jerome Powell in my room, and I will feed him fruit every day if he gets us through this without a major disruption. What do they call that? A shrine. Lack of financial stability for peak boomers may be compounded by funding uncertainties of Social Security and some defined benefit plans which could reduce some benefits. A little on demographics. Many also underestimate how long they will live. Oh my God, longevity is like a huge thing. One of the big things I will tell you in the new model is you stop betting on markets and you bet on your longevity as an asset class. People don't understand that. You can actually benefit by betting on how long you can make yourself live. And we're doing a good job on this. I'm working on a case right now with someone, and we're looking at how much they make if the markets do so-and-so, and how much they would make if, like their grandparents, live to be in their late 90s. And man, what a great bet that is to bet on their longevity. Longevity is the new asset class that needs to be in your portfolio. And we will teach you in future weeks how you can actually bet and invest on longevity as an asset class. By underestimating how long they will live, many peak boomers may not recognize the value of the assured lifetime income stream. Hey, it's almost a half hour. You got to be tired of listening to me by now. So I know I promised you a bunch on solutions. This is just really rich material, and we're going to be doing future episodes. Keep watching us every week. I am going to get into, look, here's the bottom line of what you saw today. The risks are, one, longevity. People are living too long, they're running out of money. Two, there's going to be volatility, and we're going into an era that we just don't know. With these high interest rates, can we continue to print money? And is the punch bowl leaving or staying on the table of what the Fed's been doing for years and years, which is printing our way out of every problem? Does this inflation lead to a period of stagflation? And that changes the whole game. How do you diversify your assets so you're not the effect of stagflation? You're not the effect of markets up and down and where this housing market's going to go. Now, I'm not trying to be doom and gloom about it. I'm just saying we are in a new era. I want to continue to explore new era and new planning with you. I'm going to give you 3 links here, really, really important wherever you see this program going on. First off, if you see our website, it's straighttalkwealth.com. Go to straighttalkwealth.com. There should be something there for the episodes of the podcast. So check us out there. If we're on YouTube, whatever, there's going to be links. And here's what I'm going to put in the links today. I'm going to include the report, the white paper that we went through, so you can read all of the details. I just went through the highlights. 2, I did a training for my clients about a year ago on stagflation, what it looks like, what causes it, what is the scenario going to be as it unravels. You really need to be educated on that. I created a course. You can sign up for that, no charge, no obligation. We will put a link there. Watch the stagflation course. Go to the landing page, sign up. It's about 45 minutes online. It will really give you an oversight of stagflation, how to stay safe. We've got great strategies for that. And then lastly, what do you do personally? What should you be doing? How does this all relate to your situation? I can never give advice off the cuff. What we've done for 27 years in this practice is do a retirement roadmap, retirement analysis, and projection. We get all the facts. We get the scenarios that we have looking in the environment combined with your personal circumstances. And then we can give you one-on-one advice. There's no charge for that. There's no obligation. I'm obliged to do it because I've got to operate in your best interest. And if I don't do an analysis of what your situation is, I can't know what your best interest is. So you can have that study for no charge, no obligation. It's always an epiphany. So those are the 3 offers I've got for you today. You get the white paper that I covered. We'll give you that to download. 2, you want to do the stagflation training. Great, good education. 3, work with me one-on-one for no charge, no obligation. We'll put a plan together for you. You can take it or leave it, okay? Thanks. Next week, we come back to this subject. We talk more about, a little bit more about some of the circumstances. We didn't go into Peter G. Peterson Foundation. I want to go more into that, and we will get into solutions. Until next week, see you again. Oh, and don't forget, things are going to change.